Hello everybody, this is AK. I'm back. So on screen you see a screen capture of my latest blog post. Alright, I published on Friday to update readers of my blog what I did to my investment portfolio. So if you enjoy reading more than listening to me talking, I'll leave a link to that blog post in the description box below, and you can go and have a read. It's a very short blog post, right? A quick update. Right. So in this video, I want to talk about inflation and whether it's moderating in 2024, specifically in Singapore. Right. So apparently, inflation in Singapore is at 4.7% in October, and is up from 4.1% in the previous month. So overall inflation has gone up, right? But it's largely because of higher private transport costs. So basically cars, private transportation. People go crazy buying cars, and COE went up so high. Singaporeans, many of them are so rich, or they are willing to borrow a lot of money, one or the other. I'm willing to bet it's people borrowing a lot of money, which is okay. It means good for the banks, right? And the finance companies maybe, right? So I don't mind people spending money lining my pockets indirectly, right? So but in terms of core inflation, core inflation rose only 3.3%. And this is expected to moderate in 2024, right? And core inflation excludes accommodation and private transport costs. So when you compare 3.3% against a 4.7% overall inflation, private transport costs have inflated the figure quite a bit when it comes to overall inflation, right? And MAS expect inflation to moderate in 2024, continues to moderate, and they cite the reasons of having a strong Singapore dollar, and also basically food commodities, manufactured goods, all the prices have continued to moderate, right? So coupled with strong Singapore dollar, we should see inflation gradually coming down in Singapore in 2024. There's good news for consumers, but there's also I have to wonder if prices are all coming down. Is that an early sign that demand has weakened as well, right? Just me thinking talking to myself as usual, right? And basically, as investors, when you think about inflation moderating in 2024, we think, well, will interest rates come down? Well, of course, since we don't set our own interest rates, it depends on what the US would do, right? US is what they are going to do in 2024, right? And let's see if inflation comes down to the 2% target that the Fed wants. I don't think it will happen in 2024. You just have to be realistic enough to live with higher inflation for a while more, right? And so if inflation doesn't come down to 2%, then interest rates are likely to stay higher for longer, which is why on screen you see the question, good news for REITs. I say maybe, right? Because if the Fed doesn't cut interest rates, then interest rates will stay high in Singapore as well. So no, not good news for REITs. But of course, this is good news for the banks. So if you are invested in DBS, OCBC, and you'll be like what Mr. Piyush Gupta said, right? The higher for longer interest rates environment will be good for the banks, right? And we should see them continue to bring home the bacon and maybe larger portions as well, right? So that's why I caution people when they think that interest rates are definitely coming down in 2024, like maybe second half of 2024, that kind of thing. I say, don't be too sure, we don't know that. We don't know that for a fact, right? It's all based on what some experts think should happen, right? And we also have to be realistic enough to question if interest rates should come down in 2024, like second half. How much would it come down by? Because interest rates have gone up by so much so quickly, in the last 1.5 years. It went up from 0 to 5% in the US, basically, that kind of thing. Even if it goes down by 1% or 1.5%, which is quite a bit, any REITs or any company that is highly indebted or has some debt and they have to refinance next year, they'll still be refinancing into much higher interest rate, right? So you're talking about from maybe 1.3%, now it has gone up by 5% or 4%. You're talking about 1.3% interest. Maybe now you have to pay at another 4%, so it's at 5.3% interest. That's a huge jump. That's several times higher than what the interest rates used to be, right? That's going to have a big impact, right, on REITs and on any entity that's indebted. So it's not just companies, it's also individuals, right? So like some experts say, there's a lag, right, when it comes to the impacts on the economy. We haven't seen the full impact of higher interest rates yet, much higher interest rates, which is why I say I'm continuing to build up my cash position, my war chest, because I think there's quite a bit of risk that things might go horribly wrong, right? And of course, people say, oh, but if things should go horribly wrong, that's when interest rates will get cut dramatically, right? But I also say that, if things should go horribly wrong and inflation stays high, then we are caught between a rock and a hard place. So holding some cash, more cash in fact, is probably not a bad idea. Now, if you look at Singapore's economy, right, Mr. Lee Hsien Loong said that Singapore's economy has been seeing signs of sluggish growth, and he reported that Singapore economy, by CNA, it was reported, right? They reported that Singapore economy expected to grow by about 1% in 2023, right? And in 2024, they expect maybe another 1% growth as well, right? So it's not strong growth, right? But I say sluggish growth is still growth. Let's hope it doesn't go into negative territory. So be realistic, don't be overly optimistic or pessimistic, be pragmatic. Stay invested, but have a war chest ready. If AK can do it, so can you. Bye-bye.